When a company decides to go public, it's a huge deal. But how do you, as an investor, really know if you can trust their numbers? Well, that's a big question, and Nepal's Securities Board, or SEBON, has just rolled out some new rules to tackle exactly that. So in this explainer, we're going to break down what these new IPO guidelines really mean.
So here's what we're going to cover. First, we'll look at why we even need these new rules. Then, we'll dive into the specific red flags that'll trigger a review, both the general ones and those for key industries. We'll also talk about the people in charge of making sure this all works, like the financial experts and issue managers. And finally, we'll wrap up by looking at the big picture, what this means for creating a more transparent market. All right, let's jump right in with the most important question. Why now? What's the real reason SEBON decided it was time to tighten the rules?
It all boils down to one crucial thing: protecting you, the investor. These new guidelines, which kick in from BIShock 1 2083, are all about stopping something called window dressing. That's basically when a company tries to make its financials look way better than they actually are right before an IPO. The whole point here is to make sure the numbers you see are the real deal, reflecting the company's true financial health.
Okay, so what exactly is SEBON looking for? They've set up some universal red flags. Think of them as automatic triggers. If a company hits one of these, it doesn't matter what industry they're in, they're getting a much closer look.
First up is a big one: uncollected revenue. Imagine this: if more than 75% of a company's sales are just sitting there as IOUs, what we call trade receivables, that's a huge red flag. You've got to ask, are these sales even real? And is the company ever going to see that cash? SEBON wants those questions answered before any investor money is involved.
Okay, another major trigger has to do with deals done with related parties. We're talking about insiders here, people like major shareholders or company directors. If over 30% of a company's assets or its revenue comes from transactions with these insiders, it could be a clever way to cook the books. So a review gets triggered to make sure these deals are on the level and priced fairly.
And it's not just about the numbers. The new rules are also looking for some pretty suspicious moves. Like, let's say a company suddenly changes how it does its accounting right before the IPO. Or maybe they use a one-off profit to make their year look good. Things like that, or big corrections to old financial reports, are exactly the kind of red flags that will get you a second look. The auditor's report? Oh, that's absolutely critical. Think of it like a referee's call. A qualified opinion is like a yellow card. It means the auditor found some issues and things need a much deeper review. But an adverse opinion or a disclaimer of opinion, that's a straight-up red card. Game over. The company is immediately out of the IPO race. No second chances.
So we've covered the rules that apply to everyone, but SEBON knows that one size doesn't fit all. Different industries have their own unique quirks and risks, right? So the guidelines get even more specific, with rules tailored for key sectors.
Specifically, the regulations zoom in on four major sectors you see a lot in Nepal's IPO scene: manufacturing, hotels and tourism, hydropower, and investment companies. And yeah, each one gets its own special set of tripwires.
And when you look at these industry-specific rules, it's pretty insightful. For a manufacturing company, for example, if their profit margin suddenly skyrockets by more than 30% compared to their average, that's a red flag. For hotels, the bar for uncollected revenue is a bit lower, just 15%. With hydropower, they're watching for projects where over 30% of the cost goes to related insiders. And for investment companies, if they're using more than half their capital on stuff that isn't their core business, that's going to trigger a review.
So, okay, let's say one of these red flags gets raised. The company's books are now under the microscope. But who's holding the microscope? That's where the independent financial expert comes in. And we're not talking about just any accountant. This person is basically a financial detective. They're an independent, neutral investigator chosen by SEBON. Their one and only job is to dig deep, get to the bottom of the numbers, and figure out if the company's story actually holds up. And believe me, the bar to become one of these experts is set incredibly high. You need at least a decade of experience as a chartered accountant, or 5 years if you've got a certification in forensic accounting. But the most important part, they have to be completely 100% independent. No conflicts of interest, and they can't have worked with the company in any way for the past 3 years. But wait, before an expert even gets the call, the process actually starts somewhere else. The real first line of defense is the issue manager. That's the merchant bank guiding the company through its IPO journey.
This issue manager has to hand in something called a due diligence certificate. You can think of this as their official promise to SEBON. They're signing off saying, yes, we've gone through everything, checked the financials against all these new rules, and we flagged anything that looks suspicious. So there's a really clear process here. Step 1, the issue manager does the initial homework. Step 2, if they find a red flag, they have to tell SEBON right away and suggest 3 qualified experts. Step 3, SEBON picks one of those experts. And finally, that expert gets 30 days to do their investigation and file a report. It's a very structured system, which is great for accountability.
Okay, so we've walked through all these rules, numbers, and processes, but what does it all add up to? What's the big picture goal for Nepal's stock market?
At the end of the day, it's all about one thing: trust. By making the rules tougher, SEBON is trying to build a market that's more solid and reliable. More scrutiny before an IPO means safer investments for you. And safer investments, that builds a stronger, more credible market for everyone.
Look, this new framework is a major step towards more transparency. There's no doubt about it. The real question is, what happens next? Will it actually build that long-term trust among investors? And will it attract more top-tier, honest companies to go public? I guess that's what we'll all be watching to find out.